Matthew Wolf's investment approach centers on a specific form of value investing, tailored for the unique dynamics of emerging markets. His method is not about simply acquiring assets that appear statistically inexpensive. Instead, it is a disciplined search for high-quality, market-leading corporations that are experiencing temporary mispricing. He targets firms whose share prices have declined due to broad market sentiment, due to political anxieties, and due to macroeconomic headlines rather than a fundamental decay in the underlying business itself. This distinction is the cornerstone of his strategy, aiming to separate temporary market moods from permanent business problems. The core objective is to identify durable enterprises when they are out of favor with the broader investment community. The focus on emerging markets introduces a layer of complexity that requires a nuanced perspective. These markets, by their nature, can exhibit higher levels of volatility, currency fluctuations, and regulatory shifts compared to more developed economies. Wolf's methodology is designed to navigate this environment by anchoring decisions in the tangible, long-term earning power of a select group of companies. He operates on the principle that while market sentiment is fleeting, the intrinsic value of a well-run, competitively advantaged business is far more resilient. This philosophy necessitates a patient and selective mindset, prepared to wait for the right confluence of quality and price before committing capital. His process begins with an exhaustive assessment of a company's operational health and strategic position. The initial and most critical phase of Matthew Wolf's investment process is an uncompromising focus on business fundamentals. Before any consideration is given to a company's stock price, the business must pass rigorous tests confirming quality and durability. This analysis begins with a deep dive into the company's financial statements. Historical revenue growth, profit margins, cash flow generation, and, importantly, the return on invested capital. He seeks a business that can grow profitably and efficiently, earning high returns over a full economic cycle. Beyond numbers, he evaluates competitive standing and market position, seeking clear industry leaders. He evaluates strategic direction and management quality and the strength of corporate governance practices. A crucial question is whether a durable competitive advantage, a moat, exists to protect profitability for years. This could be a powerful brand, proprietary technology, a low-cost advantage, or significant network effects. Balance sheet strength is another pillar. Debt levels, liquidity, and capital structure for resilience. After a company has been confirmed as high quality through fundamental analysis, Matthew Wolf's process shifts to valuation. The question is whether market price offers a discount to intrinsic value. Even the best company can be a poor investment if the price is too high. Wolf employs standard valuation metrics: price to earnings, price to book, and enterprise value to EBITDA, analyzed versus the company's own history, its peers, and the broader market. The search is for valuation dislocations, moments when price detaches from long-term earnings power, often driven by top-down concerns, political instability, negative macro forecasts, industry regulation, or general risk-off sentiment. During these periods, investors often sell indiscriminately, pushing down high-quality companies and low-quality ones as well. Significant pricing gaps can emerge. Wolf is selective. The thesis requires two elements. First, a high-quality business. Second, a clear, substantial mispricing. This dual filter reduces value trap risk. Matthew Wolf's methodology can be seen in his analysis of companies in China and Indonesia. In China, he has examined Tencent, with dominant positions in social media, online gaming, and digital payments. Social media, online gaming, and digital payments. He studies core segments and user engagement on platforms like WeChat, assesses gaming profitability, and projects growth in fintech and cloud. Risks include the evolving regulatory landscape and slowing user growth in mature businesses. A dislocation may occur during regulatory scrutiny or geopolitical tensions, prompting international selling despite continued cash flow strength and market leadership. If earning power remains intact, a sharp price drop can be an opportunity at a sufficient discount. In banking, he has looked at China Merchants Bank. He focuses on loan quality, deposit stability, and net interest margin, sources of fee income, risk management protocols, capital adequacy, and return on equity over time. Mispricing can arise when credit fears drive indiscriminate selling across banks. In Indonesia, PT Bank Central Asia, BCA, is another example. Reviewing its dominant retail and corporate banking franchises and leadership in digital innovation, consistent profitability, capital position, and loan loss reserves for resilience. An opportunity may emerge during rupiah weakness or election uncertainty if fundamentals remain sound. A critical element is disciplined execution of the plan. It includes carefully timed entry points, a patient holding period, and clear criteria for exit. Entry is deliberate only when a valuation dislocation is identified. After fair value is estimated, he sets specific buy targets. This helps prevent emotional decision-making and ensures purchases meet margin of safety criteria. Entry may be staggered, adding if price falls further below intrinsic value to mitigate the risk of mistiming. Maintaining cash reserves enables opportunistic deployment when pessimism deepens. The holding period is long-term. Convergence can take years. He holds as long as business quality remains intact, tracking earnings, competitive position, and strategic execution. Exit is disciplined. Sell when price converges with or exceeds fair value. Then the mispricing is corrected and the investment has fulfilled its role. Exit can also be triggered by deteriorating fundamentals, permanent share loss, sustained margin erosion, or a weakening balance sheet, or a negative strategic shift. Using valuation and fundamentals to guide sells ensures an unemotional approach to realizing gains and protecting capital. At its core, Matthew Wolf's approach is grounded in empirical evidence and rigorous risk management. Every decision relies on verifiable facts from company financial reports, industry data, and management disclosures. He prioritizes quantitative measures like revenue growth, profit margins, and cash flow trends over unsubstantiated narratives. This creates an analytical, neutral tone and strips away hype. The goal is an investment case built on data. Risk management is woven throughout. The high-quality screen eliminates weaker companies. A significant margin of safety buffers valuation errors and macro risks, political, currency, governance, are explicitly considered. He seeks transparency and may demand larger discounts where accounting standards or oversight are weaker. Visuals mirror the analysis. Clean charts for price, valuation multiples, and key fundamentals over time, meant to inform, not persuade. Context includes Asian market maps, major financial skylines, and professional office scenes. The aesthetic conveys clarity, credibility, and professionalism. In conclusion, this method combines a fundamentals-first philosophy with strict valuation discipline to identify high-quality, market-leading companies temporarily mispriced by sentiment, buying during dislocation, holding with patience, and exiting when prices reflect fair value or the thesis changes.